Hello everybody. Since the last couple of months, we have been hearing GST all over the news. Have you been wondering what actually is GST? India has many indirect taxes such as central excise duty, service tax, surcharges and cesses, central sales tax, entertainment tax, luxury tax, purchase tax, octroi and entry tax, etc. Indirect taxes are taxes on goods and services. They are not taxes on income or profits. Therefore, these multiplicity of taxes on goods and services have driven up the prices of goods and services, made taxation complicated. Further, the taxation is different for each state and businesses end up paying taxes on the paid taxes. GST attempts to unify most of the indirect taxes, make it destination-based taxation and make India a unified market. For example, consider a simplistic explanation where you are a dealer in Madhya Pradesh and you are buying goods from Maharashtra to sell in Madhya Pradesh. You buy the goods for rupees 1 lakh, and since the goods is moving from one state to another, you need to pay the central sales tax of 2%. Therefore, the effective purchase price for you is 1 lakh plus 2% of 1 lakh, that is 1 lakh 2,000. Now you add your margin, that is the amount you want to make out of this sale. Let us say it is rupees 30,000. Therefore, the selling price before tax is 1 lakh 32,000. On this price, you need to add the state sales tax, say 13.5%. So that is 1 lakh 32,000 plus 13.5% of 1 lakh 32,000, which is 1 lakh 49,820. The problem here is because the central sales tax is included in your purchase price, you are unnecessarily paying tax on the taxed amount, which in this case you are paying tax of 13.5% on central sales tax amount of rupees 2,000, which is rupees 270. This is a simple example of just one tax on tax. However, in reality, many other indirect taxes would be applicable and you would be paying taxes on multiple taxes, and all this eventually increases the price of goods and services. With GST, the attempt is to remove these taxes on taxes so that as the goods changes hands from manufacturer to wholesaler to retailer, each of them can take credit of the tax paid by the previous party. For example, let's take an ultra-simplified example where there is a manufacturer, wholesaler and retailer. The manufacturer has 0 purchases and sells its goods for rupees 10,000. Therefore, the value added by the manufacturer is selling price rupees 10,000 minus purchases, which is 0. That is, the value added is rupees 10,000. On this, the manufacturer pays a tax on sales of say 10%, which is rupees 1,000. Similarly, the tax on purchases is 0 since there are no purchases by the manufacturer. The tax liability for the manufacturer is tax on sales minus tax on purchases, which is rupees 1,000. Now, the wholesaler buys from the manufacturer for rupees 10,000, and after he adds his markup, the selling price for the goods is rupees 12,000. Therefore, the value added from the wholesaler is 12,000 minus 10,000, which is 2,000. The wholesaler's tax on sales is 10% of his selling price of rupees 12,000, which is 1,200. And the tax on purchases is 10% of the price at which he purchased from the manufacturer. Since the manufacturer has already paid the tax on his selling price, the wholesaler need to pay only his value add, which is tax on sales minus tax on purchases. This amounts to 10% of 2,000, that is 200. The wholesaler thus need to pay only rupees 200 instead of rupees 1,200 if he can furnish documents which shows that the manufacturer has paid his part. The retailer, on his part, purchases from the wholesaler for rupees 12,000 and sells it to the end customer for rupees 15,000. Similar to the earlier situation, the markup of the retailer is Rs 3000. The complete tax on the sale is 10% of the selling price, which is 1500. The tax on the purchase from the wholesaler is 10% of the purchasing price, which is Rs 1200. Similar to the wholesaler, if the retailer can show documentation that the tax has been paid by the previous parties, then the retailer need to pay only for his value add, that is Rs 300. Therefore, we see that through this mechanism, we avoid taxing on tax, and the central government and state government will later share the taxed amount. Implementing GST would help in better tax collection from organized and especially unorganized sector because of the self-policing system inbuilt within GST. The goods manufactured within India will become more competitive. Currently, if something is partially manufactured in one state and then completed in another state and then sold in the third state, after adding up the taxes to the final price of the goods, it may be cheaper for the third state to import from China. Easier for businesses because they only need to deal with one taxman. Faster movement of goods across states because we wouldn't need sales tax check posts across the state borders. Similarly, there are many other benefits. GST will replace central excise duty, duties of excise, special additional duty of customs, service tax, cesses and charges, state VAT, central sales tax, state level sales tax, purchase tax, luxury tax, entry tax, entertainment tax which are not levied by local bodies, taxes on advertisement, lotteries and gambling. GST may not replace basic custom duty, export duty, road and passenger tax, toll tax, property tax, stamp duty and a few others. So will GST make things cheaper? Not immediately. In fact, applying the uniform rate of GST will increase the prices in the short term in some areas where they are currently taxed less than the uniform rate. However, in the long term, GST will reduce the prices of goods and services due to no tax on tax and improvement in productivity. If you found this video informative, please like it and share.